Good morning. Hello, and welcome to today's webinar. My name is Mark Craig. I'm Associate Director here at Jordan's. This webinar is one of a series provided free to our clients and partners and can be set against your CPD, your continuous professional development requirements, if you have them. It's being recorded and it will be available to download from our website in due course. I'm joined today by my colleague, Karina James Wiltshire. Karina is Senior Associate here at Jordan's Corporate Law.
Hello.
Good morning. Our website today will highlight the latest reforms, best practices in the UK corporate governance world. With so many interested parties in corporate governance, it can be difficult to keep on top of all the changes in this corporate governance world. So we've put together this webinar to bring it all together for you. Due to the number of attendees on the call today, you've been put on mute for the duration of the webinar. However, this is designed to be an interactive event. I'd be grateful, therefore, if you could email me on my email addresses, which are on screen. I'm highlighting with my cursor now, which is mark_craig@jordans.co.uk. So if you email me any questions throughout the session and at any time during the session, you might want to take a note of the email address now so you can ping them to me during the course of it. My email, we will then address them at the end of the session, and any of you don't get through will be answered by email after the event. We'll contact you through that. So without any further delays, let us begin. Let me get the slides to work. Okay, so I'm just going to flick through the agenda here. We're going to look at UK corporate governance reform, the FCA's latest consultation. We're going to look at some guidance relating to the annual reports for this year and last. We're going to look at what the Investment Association set out to be their remuneration principles. We're going to look at what the IEA say about the shareholder billions of last year. We're going to look at what a number of the big players say about virtual AGMs. We're going to look at what the proxy guidelines for ISS. We're going to look at GDPR, Companies House, come up with some bits and pieces, and there's some I guess more warnings, if you want to call them that, about interim dividends. And we got some little bits and pieces to tidy up with AOB at the end as well to keep everyone up to date. So first up, the FRC put out their consultation relating to corporate governance at the end of last year. They asked for all consultations, for all responses by the end of February. They were effectively, as you can see on screen, looking for a shorter, sharper code, more emphasis on stakeholders and employees, and a little more guidance on what a company has to do when it receives significant votes against, and we cover some of that as well in this session today. I guess in response to that, my institute, the ICSA, the Institute of Chartered Secretaries and Administrators, responded to that consultation, and it was interesting to me. But it generally agreed with the consultation, but it believed that the code should be aligned with the statutory requirements and pointed out a couple of areas where the code in draft diverged from the Companies Act, and a consequence of that is it could be confusion about what you're complying with. So there's some guidance on that.
How many responses did the FRC get to the consultation?
They got, so there was 230 responses, I think it was about that number anyway, and it really does show the level of interest and engagement with corporate governance in the UK. Is quite, I think, quite impressive.
Indeed.
Moving on to first up, annual reports.
And that's right. The FRC has produced this flowchart, which you can see on the screen, and it's to assist companies with complying with the provisions of the non-financial reporting regulations. As a result of these regulations, sections 414CA and sections 414CB have been inserted into the Companies Act 2006, and they supplement the existing strategic report requirements as set out in sections 414C of the Companies Act 2006. So just looking at each of these in turn, section 414CA provides that a strategic report of a company should include a non-financial statement, and that companies that should comply with these provisions As you can see in the top box there, they are traded companies, banking companies, or insurance companies with more than 500 employees. And Section 414CB provides the minimum requirements of the non-financial statement, and I will look at this in more detail in the next slide.
This is definitely a handy kind of flowchart. I mean, it's not a it's quite a dry subject, let's be honest. But what it does, I think, this flowchart, if I walk it through, it allows you to identify what you need to do for your company. So let's imagine two different companies, one being a banking company. So most banks would suggest they have more than 500 employees. So they're a bank of over 500 employees, they're listed. That ends up with them needing to comply with this box here, so the section CB, but not having to do the remainder of section C7. Similarly, then, if you're, say, a manufacturing business, 400 employees, you're not listed, you turn into, you only need to apply, apply for 44CB. Or C7, i.e. no changes to existence. So I guess it just allows us to step through that in a relatively easy way.
That's right.
Thank you. Okay.
Okay, moving on to the next slide, looking at what annual report preparers should consider when they're following these provisions. So as I touched in the previous slide, the enhanced non-financial disclosure information in section 414CB, and this provides what should be disclosed in the statement. And these are as follows, and as I said, they're the minimum requirements. Environmental matters, including the impact of the company's business on the environment, social matters, respect for human rights, and anti-corruption and bribery matters. Just moving through the slide there on the list. Greater recognition of wider stakeholder interests, the risk and viability reporting, and the FRC does give a lot of guidance on that. And disclosures related to the company's business model, that's quite self-explanatory. The business model should be revealed in this statement. Reporting against the April 2016 version of the code, and just going into a little bit more detail here on the FCA's disclosure guidance and transparency rule 7.2. This is a new rule, and they've implemented this as a result of the regulations, and this relates to the board's diversity policy. And there's a report there on action taking if a significant vote against the resolution occurred last year.
And we obviously will deal with part of that as well in a minute. But so there's a lot in this, isn't there? It's numerous provisions to consider when you're preparing the annual report. It runs the risk of things being complicated, I think, doesn't it?
Yeah, this is the task that's set for the report preparers, to make sure they communicate this key information to the investors about the company's performance, the strategy and the future prospects. So the aim of the reporter is to present it in a user-friendly, clear and concise manner.
It's not easy. It's certainly a lot of work for people to do on that.
That's right.
Thank you.
So annual reports continued. As you can see there on the screen, the FRC produced 3 thematic reviews, and it was to help companies improve the quality of their corporate reporting. And examples that we've drawn out from their examples of better quality reporting include the disclosure of information about the assets and liabilities at significant risk of material change in the next 12 months, pension valuations, and where a company's future or past performance cannot be represented through the financial report framework. Okay, so we move on to investment associations remuneration principles. So you can see on screen there, the IEA put out their principles. As you can see, promoting long-term value creation. That's no surprise, that's a fairly regular principle. Discretion the remuneration committee has in relation to particular incentive schemes. So there's again, there's not necessarily surprise there. Disclosure of relocation benefits. This is a bit more information if you're relocating an executive at appointment. So if you're drawing someone in from another jurisdiction or country.
And then it's part about reporting on gender pay gap and executive remuneration ratios, which is obviously a very hot topic at the moment, not just the reporting of it, but the gender pay gap issue. I noticed, so last week, Legal & General also stepped up the pressure on this for firms to tackle gender diversity. So Legal & General are the UK's largest shareholder, I think is what their sort of strap line is there. They hold around £1 trillion worth of assets, and they say they will vote against the re-election of chairs if the board has less than 25% female directors. So it's obviously very hot topic in the sense of it's getting a lot of attention, a lot of spotlight. And the IEA, the Investment Association, the other day just reported that this year, I think it was as at the 17th of April this year, 1 in 10 FTSE 350 companies had fallen short on gender diversity targets. So yet again, it's definitely in the interest to ensure that you're reporting correctly on this. And this, I guess, this is just such a hot piece.
Yeah, so what you're talking about, it relates to the gender pay gaps for executive directors, and it's not related to the gender pay information regulation.
Yeah, so it's all interrelated. So what we're saying here is the Investment Association needs you to report on gender pay gap, as I'm highlighting on screen, and executive remuneration ratios. And I guess not particularly not the gender pay gap. This isn't to confuse with the gender pay information regulations, the 2017 regulation, albeit it's all in the same theme. This relates to principles of good remuneration as set out by the IEA. Theoretically, it's kind of interesting, I think, theoretically, a company can comply with the gender pay information regulation, but if they don't report it correctly and they don't report the gender pay gap, or if there is one in their reporting accounts, theoretically they could comply with the regulation, but by not reporting on it correctly, they could still fall foul of the IEA's remuneration principles and fall foul of being red lettered by the Investment Association.
Yeah.
Move on to a little bit more detail, not a bit more detail, I guess a bit more in terms of what the Investment Association are talking about. So the IEA put out a report on, I'm calling here shareholder rebellions. They put out a report relating to proxy voting guidelines, and they identified that, as you can see on screen, 22% of the FTSE all-share companies obtained major votes against one or more resolutions. So, FTSE all shares around 640 listed companies, and a major vote against is defined as 20% against. So if you've got an 80% in your favour, you're obviously still in that major votes against, just to be absolutely clear on that. So I guess what we're looking at here is 22%, that's 1 in 5 had resolutions which had those significant votes against one or more of their resolutions. It's a particularly large number, I think. And the point of it is, if you see the bottom here, the footnote, if more than 20% of the votes have been cast against a resolution, a company needs to explain what actions it intends to take. It needs to publish an update no later than 6 months after the vote, and then add a final summary in the next annual report or the next AGM notice. So there's lots of things they have to do.
So lots of companies will have to explain to their shareholders what they were going to do about these shareholder rebellions then.
Exactly. So if you look at 22%, correlates to 140 companies are going to have to explain what they're going to do about these poorly supported resolutions this year, if you haven't done so already. It's very interesting to see those kind of statistics, I think.
Yeah.
So let's look at a little more detail of what constitutes that 22%. So break it down a little. 54 of the 140 I mentioned, the proxy votes, the resolutions rather, related to remuneration. So it was either remuneration reports or remuneration policy. It's easy for you to say. And so I guess it's kind of interesting to see that the remuneration, executive remuneration, is still obviously a very hot topic. And then a little more detail, I guess, on the same point. 45 again, 45 of the 140 in that 22%. the votes were against resolutions relating to company directors. So yet again, no surprise potentially that remuneration of executives and rebellions against individual executives potentially correlating there are the largest proportion of those significant votes against. The remaining kind of grey cell there is there's a very mixed bag, so it's hard to analyse them one in particular. But obviously, then it's this is just an interesting statistic to see, I think.
Yeah.
Moving on to virtual AGMs. So the big players, so some of the big players, PERC, Investment Association, ISS, have all come out and made explicit statements not supporting virtual-only AGMs. So ISS said they wouldn't support virtual AGMs, but they would support hybrid shareholder meetings. The ISS said similar, that they're not in the best interests of all shareholders and should not be used by investee companies. Such technology should be used in parallel with a physical meeting, as it would be detrimental to the board's accountability due to the remoteness of the participants. The PERC, so Pensions and Investments Research Council, have also expressed concerns, but again support hybrid AGMs. So I guess this point about the guidelines have therefore rejected these virtual AGMs, but a hybrid, which is, as you might imagine, in a physical meeting with an online element, are generally supported. Just read PERC's concerns here that they express concerns in a virtual meeting. So it's all in the same thing. There's a recognition though here from I think all of the bodies and all the big players that the old days of hiring the big venue for the hundreds of shareholders are over. And therefore there is support for the hybrid options, which obviously ensure that the most participants can be reached.
Yeah, the other day we were talking about the less than 10 shareholders that attended the Jimmy Choo virtual AGM last year.
And that was 2016, I think, that one. So yes, the Jimmy Choo have been a bit of a vanguard in this. They've been very proactive. They did 2 virtual AGMs in recent years, virtual only AGMs, and they obviously were able to deliver those messages to those shareholders and deliver what they needed to do in terms of their articles of association, etc. But the attendance was particularly low online, which is, I think, disappointing to see. The shareholders weren't necessarily coming out in their droves to support it. So it's a work in progress, I think, in short.
Yes. Okay, so moving on to the Institutional Shareholders Services proxy voting guidelines, as Mark has just touched on, they've rejected the virtual-only general meetings and they support the hybrid shareholder meetings. The guidelines also provide for the composition of audit and remuneration committees, which reiterate the UK Corporate Governance Code requirements. So just moving on there to threshold vesting levels for long-term incentive plans. The ISS does not typically support uncapped LTIPs, and this is in line with the code recommendation that upper limits should be set and disclosed.
LTIP, long-term incentive plans, obviously, yeah.
That's right.
Thank you.
And the guidelines also go on to talk about cash box structures of issuing shares without supplying preemption rights. Now, cash box structures, for those of you who don't know, they are a form of allowing a company to issue new shares by bypassing preemption requirements, meaning that they need shareholder approval, and provided that they are issued for a non-cash consideration, such as shares for another company. And the listed company would incorporate a new subsidiary, and that would act as the cash box.
It's a very interesting model. And obviously what you're saying here is the ISS don't support it very much.
No. And there would be negative recommendation against a company who continues to disapply for preemption rights. And just lastly there, the guidelines also relate to the ISS recommending a vote against a director that has too many board roles at a listed PLC. So any person that holds more than 5 mandates will be classified as overboarded, and we'll look at the calculations on the next slide.
Yeah. Okay,
so a non-executive director counts as 1 mandate, a non-executive chairmanship counts as 2 mandates, and an executive director counts as 3 mandates. So, Mark, if we just...
Yeah, let's just walk through this one. So, if our 2 fictional directors here, if you like. So, one is a non-executive chair of A PLC, and that scores a 2. Non-executive chair of B PLC, that's another 2. A non-executive director of C PLC, this scores a 1. Therefore, not overboarded.
That's right.
It's not under 5, is it? It's up to 5.
That's right.
Okay.
And the ISS would not prevent that person or recommend do a negative recommendation.
It wouldn't go negative on because it's within the boundaries of the up to 5.
That's right. So moving on to the second example.
Yeah. So then I guess our second example. This person's an executive director of A PLC, so they score a 3.
That's right.
And 1 non-executive director of B PLC, which gives them a 1, but a non-executive chair gives them a 2. These are obviously all just to give us an example. That means, according to the ISS, that they are overboarded.
That's right.
It's over the 5 threshold.
That's right, and they would give a negative recommendation for that person being a director.
Because they're overboarded, they consider to be too busy, too
right.
exposed. Okay, so I guess there's what other factors do the ISS take into account when they're deciding whether a director is overboarded or not?
They will consider the nature and the scope of the individual's appointments, so the types of companies that they are directors for, so whether the company is highly regulated.
Okay, so yeah, if they were highly regulated, they might have a different opinion again. Yeah. Interesting. Okay. Moving on. GDPR, well, we had to say it, didn't we? General Data Protection Regulation, 29 days to go. If you're not already there, it's GDPR is coming. There's no point in sticking our heads in the sand on this one. It's absolutely on its way. GDPR is going to harmonise and help facilitate the movement of personal data within the European Union. The big change, I think anyway, a big change is that the local data regulators, so in the UK that's the Information Commissioner's Office, the ICO. So the ICO are going to have significantly increased powers to fine parties for breaches of data protection. So in the olden days, indeed currently right now, the maximum fine that the ICO can deliver is £500,000, and under GDPR, the maximum fine will be 20 million euros or 4% of your global turnover, whichever is the higher. So it's a very significant increase and something that is going to make a few risk registers twitch, I'd suggest. As a consequence, breaches of data protection, so you can see they're going to be treated much more seriously. And in case you're wondering, Brexit will have no effect on GDPR. The UK government have already very firmly confirmed that.
We ran a GDPR webinar on the last month, didn't we?
We did, yeah, we did. So there's a link on screen there at the foot of that slide. Linking to a recording of the webinar that we put out last, the free webinar that we put out last to our clients and partners last month. Our colleague Simon Bates talked about a number of quick wins that our clients and partners can do to get ready for GDPR. There's an awful lot on this. It's a big subject. It needs to be taken seriously and it should not be underestimated.
Indeed.
Companies House. So we're kind of moving into the last few slides here. So Companies House are going to undertake a review of data quality. They've come into this some time ago. And one of the things they're doing going forward, I think this is part of a list of nationalities and countries of residence. So Companies House are going to reject any forms if the nationality or the country details do not comply with the guide, and they've issued a guide of all the nationalities that they recognise at the end of last year. And you know, it's just kind of a very extensive list.
Does this just relate to new filings?
Yes, it does, I guess it is a very extensive list. I can't remember the offhand the number of nationalities that they recognise, but it even includes Northern Irish as a nationality, so it's quite a big list. If you don't complete the forms using one of those defined nationalities, your filing may be rejected. So it's worth ensuring you're aware of what you're submitting.
That's right.
Interim dividends.
That's right. So as you can see, there's some big names there on the slide. Section 830 of the Companies Act 2006 provides that a company can only make distributions out of profits available for purpose. So last year, the fund supermarket Hargreaves Lansdown had broken or breached UK company law on dividend payments to shareholders, and these shareholders included the founders Peter Hargreaves and Stephen Lansdown. So the FTSE 100 listed broker was technically in breach of the Companies Act, and the reason it was technical was because it failed to file accounts justifying the dividend payments. Also last year, the rest of those on the screen, Dunelm, Domino's Pizza and Next PLC, were also found to have paid illegal dividends, and that was due to having the lack of profits available to make distributions. So they were in breach of Section 830.
These are some big names. I was kind of interested in that. How are these companies identified? How are they singled out by the FRC?
So what they do is random checks and reviews, and it is a substantial review, and as you can see, these high profile cases were found out, and the crux of it is that it's a piece of paper that wasn't submitted to Companies House that landed these big names to be breach of the Companies Act.
So they hadn't submitted their interim accounts in order to make those payments. Okay.
That's right. Okay, so
yeah, go ahead.
Yeah, the extension of the senior managers regime to all financial service firms. So the FCA have extended the senior managers regime, and as you can see there on the screen, it's a 3-tier application that they've suggested. So at the top there, senior managers regime, this would apply to individuals who hold senior management functions, which the FCA prescribes, and the FCA identifies senior managers in relation to the firm's regulated activities, the individual's performance of the role, and whether that role involves a serious risk of consequence for the firm or for businesses with other interests in the UK. So the senior manager's role applies to anyone who performs a senior manager's role, whether they're based in the UK or overseas. So moving on to the second tier, enhanced regime, this would apply to mortgage lenders that are not banks. And the bottom of the triangle there, limited scope regime, and that would apply to, for example, sole traders.
So are all financial services firms going to have to make submissions to the FCA on this?
No, the majority will automatically convert over. However, banks, for example, would have to submit a conversion notification and all the accompanying documents.
I think if you're affected, you might just want to bear that in mind and check, I think.
That's right.
Okay, so we're moving on to ESMA, so the European Single Electronic Format. So as you can see on the screen there, from the start of 2020, listed companies will have to prepare annual financial reports in a format known as ESEF, European Single Electronic Format. So the ESEF format enables software analysis and the ability to compare different reports, even though they might be even in different languages. So the point here is that this is in some ways an extension of what we've been doing in the UK for some time, I suggest, the XBRL format, and for US listed companies, EDGAR format. They've been in place for some years now. This is just kind of bringing everyone up, I think, to the same standard, but it's, again, it's something to be aware of.
That's right.
More AOB.
That's right. So Market Abuse Regulation, or MAR for short. The FCA has taken enforcement action against an AIM quota company for the first time since it came into effect on the 3rd of July 2016. And it was the first foul of MAR. And that listed company was fined 70,000 for breaching Article 17 of MAR because it failed to release an announcement as soon as possible after being notified of inside information. I think what should be noted here was the seriousness that they are treating this new regime, and what's not allowed is a grace period for misunderstanding the new requirements. That's not a defence.
Yeah, as you say, ignorance is no defence of the law. Is that what you're going to say in here?
That's right.
Oh, a significant fine. Okay, on to the last piece here. So again, just some final housekeeping. If Just a reminder, the London Stock Exchange put out that your LEI, your legal entity identifiers, must be put onto your London Stock Exchange, additional information as well, onto the London Stock Exchange announcements, anything you put out if you're a listed company. And if you missed the deadline for registering to get an LEI, you have to do so immediately. So if you're not on top of that one, get onto it as soon as you can, I think.
Yeah.
Next time you need to make a stock exchange announcement, you'll need that number. So just to wrap up here, I think there's I encourage you to sign up for free corporate governance updates. I can encourage you to sign up for free future webinars. These are, as I say, free to our clients and partners. Anyone who's interested can make use of that. I think if you want to stay abreast and up to date with the latest news, you could do worse than sign up for these things. As I mentioned, these are a series of webinars. This is one of in a series. So if you're interested in being alerted to them, you can sign up to be alerted to these future ones. As I say, they're free. I keep saying that. I know a lot of people charge for these, so it's kind of just useful. We're hopefully giving something to our clients and partners here. Hopefully informative. They're hopefully interesting. And they do count towards your continuous professional development time if you have that requirement. So I will now ask for any questions. We'll move on to the questions. If you have any questions relating to the webinar today, if you could email me at the email address on screen. I'm just pointing at it with my cursor again. So mark_craig@jordans.co.uk. We'll try to get to your questions during this webinar, but if we don't get back to you at any point, or if there's something we need to get clarity on, we'll get back to you by email after the event. We have a question that's come through. What are the sanctions for not complying with the Investor Association guidelines about gender pay? So the IAA, obviously, a slide earlier on, suggested there was some guidelines that you needed to comply with relating to reporting gender pay gap and for executives. So the IAA's powers are limited. The IAA is a trade body that represents UK investment managers. So they promote UK investment management. They've got 200 members. And when I looked this up, they've got £7 trillion worth of assets. For comparison purposes, the UK's GDP is about £2 trillion worth. So these are very significant players in that market. Investment managers, those 200 investment managers with those assets, listen to the trade body. So while the IAA can't fine or sanction an offender, the IAA does have some powerful friends who will make themselves known to offenders. So one such consequence of being singled out is that you might not get your resolution through because you have significant votes against. If there's any questions coming through, please let us know. In conversation with our colleagues the other day, there was a question about listed companies, how they get their messages out to their clients. So I think I just will paraphrase some of the question and answer to that. There was a question about how do listed companies get their messages out to clients for reporting purposes. quite often they will send an email to their shareholders alerting them to the fact that the report and accounts is available on their website or a website of their choice, and the shareholders will click that website and download a copy of the report or some information relating to the report. Just kind of paraphrasing that. I'll give another minute or so for any other questions along the way. Nothing else is coming through at the moment. I want to respect everyone's time, so if there's nothing else to talk about, I'm happy to close up. Do email me with any questions after this event. We're happy to respond after the event. So we're going to wrap it up about there, though. So thank you for joining us this morning. We genuinely hope you found it useful and interesting. As I say, we've made a recording of this webinar today, which will be available to listen again from our website. So if you or your colleagues want to listen again to it, you can do so. Please keep an eye out for future free webinars at our website. And until the next time, thank you and goodbye.
Thank you.